I'm Bambi Francisco with Vader News, and I'm speaking with Ken Sawyer. He is the founder of Saints Capital, which is a direct secondary market company. Ken, thanks for joining me for this second part of this interview. We were talking a little bit about your about the environment for you, the favorable environment for you to buy a lot of these venture-backed deals at discounts. Curious, who is selling their assets? What kind of firms are selling?
It's really a broad base of sellers. We did transactions last year from publicly traded business development companies that had investments in the space, like Safeguard Scientifics, where we announced a transaction. We also did transactions with corporations who, for strategic reasons and for capital reasons, decided to transact. We bought a big portfolio of assets from Boston Scientific Corporation. We also transacted with venture capital firms. We bought an old fund from Innovacom, 10 companies. Innovacom is a French venture capital-based company that had investments in both France and in the United States, and we did a transaction with them. And we also did transactions with hedge funds, with founders who needed liquidity, with banks and other financial investors, and with limited partners that were looking to reduce their exposure to venture capital or buyout assets.
So there's definitely opportunity for firms such as yours, such as a direct secondary market company. But there is a difference between your direct secondary market company and a secondary player. So just so the audience isn't confused, what's the difference?
It is a very confusing term, and there are a large number of very large players who are called secondary firms. What that vernacular refers to is people who buy stakes, limited partner stakes. So an endowment, a university, Harvard may have a $20 million commitment to XYZ venture capital firm, of which they've invested 5, and they have an obligation to invest 15 more. And the course of sorting things out, and it was public that CalPERS, for example, sorted out their investments in buyout firms and venture firms, and they sold a number of them on the secondary market.
And Industry Ventures, which raised over $200 million, that they are a secondary market player. They don't really compete with you.
They invest in limited partnership stakes. They will be a GP, a general partner, who will receive management fees and carry. So Industry Ventures will charge their limited partners money, fee, and carry. And then they will also pay fee and carry to the GP managing the assets. And by the way, Industry Ventures at $200 million, the secondary market is in the billions. Firms like Lexington have several $billion under management. Collar, $4 or $5 billion in their most recent fund. HarborVest, Paul Capital, Adam Street. So it's a multi-billion-dollar marketplace. Many of those folks invest in us, and we're very different in that there's no intermediary. We sit on the boards. We manage those investments directly, and we don't pay management fees or carry to anyone else. So when a limited partner invests in our fund, there's not 2 levels of fees. There's just 1 set of fees paid to us.
Paid to you. So on that note, you sit on the boards of these companies. Do you also have funds to reinvest?
Oh, absolutely.
Okay.
So part of the reason in many cases people will consider selling a stake is there are future capital obligations. These companies need more money. They need more money invested. So even if a venture capitalist has put $10, $15, $20 million into a company, they may say there's another $10 million that's still required, and they may or may not want to fulfill that obligation to continue to support that company. We'll often step in a number of circumstances and provide additional follow-on capital to help that company grow and be successful. Certainly not in all cases, but in many cases we're prepared, stepping into the shoes of an investor in this particular company or in a portfolio of companies, that we understand and we are reserving a substantial amount of money to invest and support.
What about your exit opportunities? So you're an exit opportunity for a lot of the venture-backed deals that don't have exit opportunities, and what about yours?
Well, keep in mind, the structure of most venture capital funds is they are a 10-year life. In a period of time where the average exit, and the average exit is 7 to 8 years, and if you think about a normal distribution curve around that, that means you're going to have several companies that might be 12, 14 years. And if you think you're investing over the first 5 years, so there's some investments done in year 3 of the fund, year 4 of the fund, and year 5 of the fund, the structure, the historical structure of the venture capital fund model doesn't allow enough time to truly get all of these exits. So what we're coming in and doing is buying assets that are what we call aged. The money has been invested for a while, and it may be in the ground 4 years or 6 years or 8 years already. And so we understand that our holding time also may be another 4, 6, or 8 years, but we're seeing exits at some point in time. So what we're doing is really resetting the clock, buying these assets after they've been around for a number of years. Our exit opportunities are the same as most venture firms: IPO, strategic exit, or a sale to another secondary investor. Those are really our exit opportunities. It's just that we're doing it after, 4, 6, 8 years have already passed.
What about the investments that you've made in the past? Are you seeing investments you made in 04, 05, 06? Are you seeing any exits? Like last year, what type of exits did you have?
Well, we had reasonably good years in both 2007 and 2008. We had 7 IPOs, for example, in 2007 on NASDAQ. I think that accounted for 20% of all the tech IPOs were portfolio companies that we had. In 2008, we had only 1 IPO, and fortunately that company did quite well. A company called CardioNet that we acquired from Boston Scientific that did a secondary offering after we had acquired the stock. But most of our exits were strategic exits. We still returned over $160 million of capital to our limited partners in 2008, mostly through trade sales. So on balance, it was, compared to most funds, we were successful at achieving exits. But it's overall, we suffer from the same challenges with our existing portfolios that all VCs suffer from today.
But not all VCs were part of the Forbes Midas Touch list, I'd have to say, right? So
that's
congratulations on that recognition, Ken. And we'll wrap it up there, but thanks for your insight on the direct secondary market industry, Ken.
Great, thank you.
And good luck to you. I've been speaking with Ken Sawyer. He is the founder of Saints Capital. I'm Bambi Francisco.